Hello and welcome everyone. In this video, we will be taking a look at three ETFs which I believe could become a really good investment in the year 2025. These ETFs are the Evolve Global Materials and Mining Enhanced Yield Index ETF with the ticker symbol BASE, the Global X Gold Producer Equity Covered Call ETF with the ticker symbol GLCC, and also from Global X, the enhanced MSCI Emerging Markets Covered Call ETF with the ticker symbol EMCL. Each of these three ETFs is an income oriented ETF, but also provides potential for capital growth. More importantly, they all provide unique value. In case of BASE and GLCC, they operate in the metals and mining industry, which is traditionally considered safe and profitable, but might be somewhat undervalued in the current market conditions, which are more in favor of tech stocks. In case of EMCL, it covers a geographical region which traditionally has not been seen as a great investment opportunity. But there are a few recent developments which may change that. So, in this video, we will discuss the pros and cons associated with these ETFs and why I believe they are undervalued right now, but could provide long term value, both in terms of capital growth and income. BASE is an interesting ETF which mainly focuses on companies involved in mining activities and processing of metals. Based on its most recent stock price, it is yielding around 10.5% annually, and the income is paid out on a monthly basis. All of its holdings are profitable dividend paying companies. However, year to date, this ETF is down over 20%. This may seem quite surprising given the fact that it operates in a somewhat stable industry, mining and processing of metals, which provides base materials for other industries, hence the ticker symbol BASE. But if you look at the broader market trend, this 20% decline is not as surprising as it appears at first glance. This ETF performs best when the overall market conditions are bearish and investors are encouraged to invest in companies that are traditionally considered safe. If you look at its historical trading prices, this ETF reached its all time high in March 2022, a period during which the rest of the stock market, including the tech sector, was in a bearish territory. Right now, the overall market trend is much more bullish and in favor of tech stocks, where investors feel more encouraged to invest in more risky, growth oriented companies. Hence, people who might have invested in the companies held within this ETF during an uncertain period in the past are probably shifting their capital into other companies where they expect higher short term returns. This is true for both retail investors as well as institutional investors such as hedge funds. So, the year to date decline is primarily a reflection of broader market trends rather than how well its holdings are doing. Hence, I feel this ETF might be undervalued. Combine this with the fact that it is yielding more than 10% annually. This might be a good long term investment, providing not just high income, but also a good prospect for capital growth. In fact, if you look at its historical prices, the only time it traded significantly below its current price was back in March 2020, which was due to the panic selling caused by COVID. It is still possible that it might go down by a dollar or two, but I do not expect it to go down any further than that. I'm personally comfortable buying this ETF in the price range of $20 to $24, where I'm guaranteed to receive a 10% annual yield based on its current monthly payout of 20 cents per share. I think for most of 2025, it will trade within this price range, giving investors a good opportunity to buy it at an underpriced valuation. The next ETF that I'm definitely buying throughout 2025 is GLCC, which is the Global X Gold Producer Equity Covered Call ETF. If you have watched one of my previous videos where I talk about my top 3 holdings, you know that this ETF is already a significant part of my portfolio. At its current trading price, this ETF is yielding over 10% annually, and the income is paid out on a monthly basis. Just like Base, this ETF holds stable, profitable, dividend paying companies. In this case, however, the companies only focus on mining and processing of a single metal, gold. When it comes to investing in gold, most people think of it as a hedge against economic collapse, a way to preserve value. This in turn makes its price quite volatile, making it a perfect holding for a covered call ETF. But more importantly, it can also be used as a currency or as a backup for paper currency. The US dollar, for example, was backed by gold until 1971. Since 1971, not just the US dollar, but currencies across the globe have operated as fiat currencies, which is a type of currency that is not backed by any finite asset such as gold, but simply by the trust and agreement among all the people in the society that it has value. Throughout history, such fiat currencies are always replaced by currencies that are backed by a limited asset, and in most cases, that asset happens to be gold. If we look at gold's price chart in the last 50 years, we see that throughout the 80s, 90s, and even early 2000s, gold price moved sideways. But there was a spike between 2008 and 2012, a period when the US economy was rattled by the 2008 financial crisis. The same thing happened again during the 2020 COVID crisis. This indicates that whenever there is a crisis situation, people opt to buy gold as they do not trust the US dollar to hold its value. This is probably common knowledge, but what I'm about to tell you next may not be so common. This next piece of information is the main reason why I believe gold could end up being a very profitable investment, not just in 2025, but over the next 4 to 5 years. There is a group of countries who want to replace the US dollar as the world's reserve currency. This group is known as BRICS, which stands for Brazil, Russia, India, China, and South Africa. As of 2024, this group has expanded beyond these initial 5 countries. What I find very interesting is that these countries are buying gold very aggressively. For example, in 2023, China purchased 225 tons of gold, making it the largest buyer in that year. Also, India purchased 72 tons of gold in 2024. For context, India had purchased only 16 tons in 2023. So in 2024, they purchased 4.5 times the amount purchased in 2023. If we go back to the gold price chart, we will notice that these aggressive purchases coincide with a sharp rise in gold price. So, what is exactly going on here? As mentioned before, in order to replace a fiat currency, you need a currency that is backed by a limited asset. That is exactly what the BRICS countries are attempting. The idea being that countries who are part of the BRICS group are able to trade goods and services among themselves without the need to hold US dollar as a reserve currency. This is being done in 2 ways. First, creating alternatives to US dollar based payment systems, and second, using a common unit of currency which is partly backed by gold and partly by currencies of member countries. BRICS Pay has already been released as a payment system. Adoption might be slow at first, but over time I think it will speed up. As for the common currency, it is yet to be released, and this is where I feel there is an opportunity for investing in gold. I think BRICS countries are still in the process of acquiring more gold before they officially confirm a common currency. This process could very well last for another 2 or 3 years, as replacing the US dollar will not be exactly an easy task. If we look at the chart of GLCC, we find that it has experienced a decline of 20% over the past 3 months. This could again be just a case of people reallocating their investment in tech stocks, since tech based stocks have experienced a surge, especially after the election results. Such trends are not uncommon in the stock market. But the real trend we should focus on is the rising price of gold, which is not based on a short term euphoria, but on the actions of a group of countries with a well defined objective. Of course, this means that gold based investments other than GLCC would also benefit from this trend. But on this channel, we mainly discuss income oriented stocks and ETFs, which also provide capital growth potential. And GLCC definitely holds up as a good investment for both income and growth. Last but not the least, we will discuss EMCL, which is the Global X Enhanced Emerging Markets Covered Call ETF. As the name suggests, this ETF focuses on emerging markets. This mainly includes countries in Asia, Africa, and South America. In fact, the BRICS countries mentioned earlier, Brazil, Russia, India, China, and South Africa, are among the fastest growing economies in the world. This ETF has a yield of over 12%. However, in terms of capital gains, this ETF has mostly moved sideways in the past year. So, what makes me think that this ETF will be an excellent investment in the long term? Despite the fact that it has the BRICS countries, it is not just another play on the BRICS economy, it goes beyond that. The reason why I believe this ETF could be a good investment is because emerging markets right now are a minuscule part of the global stock market. If you look at the composition of VT, which is Vanguard's total world stock ETF, emerging markets constitute only 9.5% of total world stock holdings. However, if we look at GDP, emerging markets account for 30% of global GDP. There is clearly a mismatch here. This mismatch is primarily the result of the fact that emerging markets in the past did not have proper financial infrastructure to enable investment in their economy. So, let's say 20 years ago, if you wanted to invest in an emerging market economy, you would have to invest directly in a company over there. Investing in more liquid financial instruments such as stocks was either non existent or only limited to people within those countries. Developed economies such as US, Canada, and certain European countries had the infrastructure which allowed them to receive easy access to foreign investors. However, in the past decade, these countries have grown their GDP at a fast pace, and now they also have the financial infrastructure which allows them to receive more foreign investments. More importantly, a lot of developed countries are actually facing issues such as inflation and population decline, including the US. It is possible that the developed economies might continue to grow in the future despite these issues, but there is a high probability that they will not grow as fast as the countries in the emerging markets. This is where the opportunity lies. As countries in emerging markets continue to receive investments and also grow their GDP at a fast pace, more and more investors around the world should take notice of the pricing mismatch. So, in the long term, it could end up being an excellent investment that has a high potential for capital appreciation. Combine this with the fact that even at its current valuations, it is providing a 12% yield while maintaining a stable stock price. This combination makes EMCL a worthy investment, at least in my books. It's important to note that this ETF uses a 25% leverage. There is an unleveraged version with the ticker symbol EMCC in case you don't like using leverage. And with that, we have reached the conclusion of this video. Please note that the capital appreciation aspect mentioned for each of these three ETFs is a long term play, which should pan out over the next 5 to 10 years. I do not expect them to provide any major capital gains in the year 2025, and that is precisely the reason why I'm planning to buy them throughout 2025. When investing in stocks, it is best to buy them cheap. Also, these ETFs are primarily designed as income oriented funds. Capital appreciation is a secondary aspect. I, however, prefer to maximize my capital appreciation when investing in these ETFs. This ensures that I'm not only receiving the passive income, but the value of my original investment is keeping pace with inflation and, in some cases, outpacing it. As always, all the information shared in this video is based on my own research, contains my opinions, and is not meant as an investment advice. Please make sure to do your own research before making any investment decisions. Thanks for watching. Don't forget to like, share, and subscribe if you found some value in this video. I will see you guys in the next one.